Hey, good morning. Welcome to the mortgage rate forecast with Scott Criss, your mortgage rates and news. It is November 9th, and as always, let's get started with the charts. Here's what we got. We're currently trading at 102.89 this morning. Support's coming in below us at about 102.80 and 102.75. That's the 200-day moving average. So, really important that we keep that on our radar right now. If we do break below 102.80, our new support could go as low as 102.30. Resistance is coming up above us at still 103. That's a tough barrier. We did break through it earlier this week, but it was kind of a tough one. We had a lot of good momentum behind bonds, but as you can see over the last couple of days, we had a low opening this morning, and we also have sold off below 103 yesterday afternoon. Actually, we did put some calls out to our clients yesterday afternoon to get them locked in out of concerns of this, and I think it was a really smart move. So here's where we're at. Initial jobless claims came in. They technically came in worse than consensus, but the overall momentum of the jobless claims, unemployment, is actually a really good one for our economy. But when there's something good for the economy, it's kind of not always that great when it comes to how it reacts with bonds. So at any rate, that's had a negative impact. But I think the biggest thing is really the bond auctions that are going on right now. So we're going to be really keeping a close eye as the 30-year bond auction comes up this afternoon. And a really quick note, we are going to see a 20 basis point rollover tomorrow on the coupons. So that means if we close at 102.80 today, we could open tomorrow at 102.60. So here's where we're at to kind of quantify. Freddie Mac still has not released their October numbers, but for September, they're still at 3.81% for a half a point. And average trading back in September was about 103.40. So to quantify this for you, that's 51 cents worse in trading on the market. And if we're 51 cents worse in trading, and the average consumer is already paying half of a point, well, that puts the average consumer right at 1 point for that same rate. So we are definitely seeing the market get a little bit worse from what we saw in September and even October. Last projection was a hit, but just barely, guys. I projected a top of 102.90, and as you can see today, we're at 102.89. So we are seeing pretty consistent outlooks from the analysts. They all seem to be pretty bearish on the short term, thinking that bonds will sell off, but they are relatively inconsistent on the long term. They are thinking bearish, maybe neutral. So here's going to be my forecast. I think we're going to be between 102.60 and 103.10 through next Thursday. But I have a good feeling we're going to be on the bottom end of this forecast, closer to the 102.60, especially with that rollover. So that means from where we're at right now, that's a fee swing of 11 to 29 basis points, more basis points to the worse. So I would just be really careful if you're out there floating right now, and definitely keep a close eye on the market. But hey, we would like to hear from you. Leave your comments down below. Let us know what you think. Everything likes to be liked. So does this video. Hit that like button before you leave. And if this is your first time on the channel, you can click that guy in the top left. That will get you subscribed. That'll just give you a quick notification when we release new forecasts with what's going on with interest rates in the market. And at the top right, if none of this made sense to you, it's okay. Mortgage bonds that are kind of tricky. Click on the Mortgage Bonds 101, and that'll teach you the basics that you really should know when you're trying to pick the best time to lock in your interest rate. Anyway, that's it for now, guys. Have a great weekend. I hope you get to enjoy a 3-day, and we'll see you next week. Bye-bye.